Well, welcome to the deep dive. We're going to go ahead and get started this morning. Welcome to everybody that joins and starts their week with us on the deep dive. As always, we start the week this way with a deep dive, giving you all the topics. If you're a KCM member, you can download these slides, take them and use them as you're talking to folks, maybe as you're sitting down with somebody that's thinking about buying a home, listing a home, or just wondering generally what's happening in the market. These are going to be some of the best slides you can do to give a visual aspect to that. So we're going to get started. I'm going to share my screen as I always do and give you the most up-to-date information right now on prices. One of the things that I think is important, remember, this is the most up-to-date information on prices from what experts are saying all over the country. As always at KCM, we're going to bring you updates when they say different things or they change their stance. And we're starting to see that a little bit as we look out across what folks are saying right now relative to prices. So we'll start right here. Taylor Marr, the deputy chief economist at Redfin, says, for those folks bearishly, eagerly awaiting home prices to crash, you'll have to keep waiting. As much as demand is pulling back, supply is as well, reducing downward pressure on prices in the short run. So what do we see happening right now, generally in real estate? Things are staying on the market longer, but we're not seeing an influx of inventory coming on the market right now, which is, keeping pressure on prices. If you had this flood of inventory coming into market, that's when we would start to see that downward pressure on prices, but not seeing that right now. So what are experts saying? That's the big question. I mentioned there's a little bit of a shift in sort of their aspect. This is the latest look here at what experts are saying relative to home price forecast for next year. And you can see here, we now have MBA, home price expectation, NAR, Fannie Mae, Ivy Zelman. We took Freddie Mac off of this because they haven't updated it since July. But the big, sort of change here, we now have two forecasters calling for depreciation, three others calling for appreciation. But the average, if you were to take all of these, just over, flat pricing, 0.2% appreciation relative to real estate nationally going into next year. I think this is an important point to look at, that this sort of best case scenario is a flat market relative to home price appreciation. The reality likely is there will be markets that appreciate and markets that depreciate across the country, giving us this overall national look of a sort of an even market, a flat market. Right now, I think is the most important time to be able to bring locally what's happening with prices into this conversation. What's happening with inventory, what's happening with demand, how does that look? So I think that's critically important. I want to give you another sort of look at this from banks. This is a look at what banks are saying. You take Goldman Sachs, Wells Fargo, Moody's, Morgan Stanley, all of them calling for home prices to depreciate next year. Now, I will say this. There's a very interesting sort of mix right now in the market. Those that focus on builders and publicly traded builders are calling for depreciation. I would put banks in that category. There are others in that category. Those that focus on existing home sales have been calling for slight appreciation. So it's an interesting nuance to how they forecast home prices, going into 2023 with everything we've seen in the market. But here's probably the most important point. What they all have in common is this forecast of this market, and I'll use Wells Fargo here as an example, forecasting depreciation going into next year, but then appreciation for 2024. This is important, and I'm going to get back to it in just a minute. But if you look at the sort of consensus of price forecasts, some have, marginal appreciation, marginal depreciation across the country. And I think this is important. I saw this a couple of days ago. Our research team found this, and it's a quote from Freddie Mac that says, while there might be little statistical difference between a small positive number and a small negative number, there are often huge differences in how they impact behavior. Think about that for example, whether homes appreciate 1 or 2% or depreciate 1 or 2%. going into next year. The way that we sort of go into that in our mental state and, the behavior that we display based upon that, I think is playing into this market a lot bigger than maybe even the difference in whether they homes appreciate or homes depreciate. Something really, really important to keep in mind as you're talking to people, as you're having conversations about what's going on with home price appreciation in this market. But here's one thing for sure. It's a very interesting statistic. As we look into next year, and what we've talked about with some calling for depreciation, some calling for appreciation, what nobody's calling for is, this extended depreciation. In the global financial crisis, what we refer to as 2008 and the housing crisis, home prices depreciated for 5 years, 2007, 2008, 2009, 2010, 2011. Most saying, hey, look, we go into next year, going to be a little bit of a rocky year relative to home prices, but going into the year after that, seeing appreciation kick back in. If you kind of go back to I'll go back here to the Wells Fargo forecast. Most generally follow that trend. Rocky year next year, but then going into a more stable environment in 2024 where we see historical appreciation. I think this leads many people to go, okay, I'm starting to see that. I have to understand my market. What's really ahead for interest rates, rising home prices over the last couple of years, rising interest rates, kind of this 1-2 punch for affordability. What's ahead relative to that? So I want to cover that just for a minute. Is another topic. Over the last couple of weeks, Kate has talked about interest rates and maybe a dovetail out of that. But a couple of things that I think will help you give advice based on what's ahead. First piece right here came out just a week and a half ago. Global CEOs see a mild and short recession, yet optimistic about global economy over the 3-year horizon. That was the title, the headline of this KPMG CEO Outlook. And they say more than 8 out of 10 anticipate a recession over the next 12 months, with more than half expecting it to be mild and short. So as the Fed continues to do their work to tame inflation, which is what this is about, and we know that's had an impact in the long-term interest rates, and inflation's always going to be the enemy of long-term interest rates. What are we going to hear? We're going to hear more calls for recession in this country. And we're certainly hearing that right now. Wall Street Journal just came out with a study this weekend, saying, hey, in the next year, we're going to be in a recession in this country. And the information certainly supports that. Now, we'll have to wait and see what happens there. But what do we know historically in a recession? Well, if you go all the way back to the early 80s, a recession means falling mortgage rates. Now, we certainly don't wish that upon anyone, and a recession is a term given to an economic slowdown. But it's going to impact businesses. But for our business, what it's meant is falling mortgage rates. Why is that? Typically, that is because housing has such an economic impact all across the country. The sale of one home, we've talked a lot about that here at KCM, impacts the economy to the tune of almost $90,000 for a new home, an existing home, about half of that, about $45,000. And so, housing will lead the way out of an economic slowdown. So seeing that to start to play out right now relative to what we believe is on the horizon, what experts are calling for as the Fed continues to do their work as they slow down the economy. I'll wrap up here real quick with a quote that I think reinforces why we need to be the expert right now. It came from Jason Lewis from Parcel. In the absence of trustworthy, up-to-date information, real estate decisions are increasingly being driven by fear, uncertainty, and doubt. These decisions can be hugely consequential for consumers and for businesses. There's no doubt a lot of people dealing with questions around uncertainty, dealing with fear around uncertainty. In times of uncertainty, we always say people follow the certain. We can be out there with these forecasts, talking about prices, talking about interest rates, talking about this market to give people what they need to make an educated decision, not to try to get to do, somebody to do something they don't want to do, but absolutely to help people understand what is happening. So I'm going to wrap up here. Daniel, I see you there. Feel better. I actually I'm doing fine. I have a little problem with my voice right now, but I appreciate that. I'll wrap up with this before we turn it back over to questions, Jess, in just a minute. This month, we just released our monthly market report. If you're a KCM subscriber, you have access to that. It's probably one of the most important housing updates for agents right now. We talk about interest rates, we talk about this pricing conversation, and we talk about equity. Everything you need to know to be up to date on what's happening right now. So if you're not a KCM member and you want to grab that, be sort of on the lookout. Later this week, we're going to make it available for a short period of time where folks that haven't had a chance to see that can get that. But if you're a KCM member, go watch that, go grab the slides and use that, as you're talking to people, as you're getting out there and having conversations. So I'm going to pause for just a second. Jess, any questions right now that have come up and anything there that people are asking?
Hi, Dave. I did just see one question come through from Connor, who said, hearing that home builders are selling new construction homes in bulk to investors to pair inventory, how widespread is that? And will that shorten the problems or lengthen them?
Yeah. Who asked the question?
This was Connor Hancock.
Connor. Okay. I don't know the answer to that, how widespread that is. Anecdotally, have heard that certainly builders are going to be selling discounts. They're not going to get premiums for what they've built. So if you feel free to send anything that you're seeing on that to me, I'm happy to take a look at it, David, at Keeping Current Matters. You can email that over.
Awesome. Thank you, Dave. And I did just see one more question come through from Jill, who said, so none of these economists were calling for that 2 months ago. Why did it change?
I think it's pretty clear. The dramatic rise in interest rates has called folks to go, okay, what's going to happen? I think it's all about affordability and interest rates right now. I don't think right now the interest rate environment that we have at call it 7%. We ended the last week just at right under 7%, but anywhere on the low sevens, what you're seeing in interest rates, not a horrible 30-year fix, but the rapid rise in interest rates is what's called for them to change their stance in some of these forecasts.
Awesome. Thank you for that, Dave. And that was the last question I've seen come through.
Okay. Well, let's wrap up on that. As always, so grateful for everybody that joins the deep dive. Like I said, if you're a KCM member, go watch the monthly market report. If you're not a KCM member and you want access to it, be on the lookout later in the week. We're going to provide it for just a short amount of time for those that don't get that. So you have that information, but certainly want you to have that. So enjoy this week. Great. Thankful for the way that you start off your week with a deep dive here, and we'll see you back next week. Take care.